afternoon. This is Lance Bryce with Thrive Mortgage. Today is Friday, the 7th of April. I hope you're doing well. We're seeing interest rates a little bit higher today than they've been this week. We had seen a nice reprieve going into this week, had a chance to lock a number of loans Tuesday and Wednesday and secure 2-month lows for those clients. And I know a lot of folks in the industry did as well. None of us wanted to float going into non-farm payroll this morning. So hopefully, if you have transactions in the queue with other lenders, they were paying attention to all signs in the marketplace and hopefully got your clients secured earlier in the week when we saw fresh 2-month lows in interest rates, because we have given back much of that ground this morning. The reason being, non-farm payroll did come in. It was close to expectations, but frankly, a little bit better than expectations. The bond market would have really liked to see some weakness in this report. What we got was 236,000 new jobs, 238,000 were forecast, but the unemployment rate ticked down to 3.5% from an expected 3.6%. Economists had expected that the unemployment rate would remain unchanged, especially given the strength of last month's report that reported February numbers of 326,000 new jobs. The bond market would have liked to have seen larger downward revisions to that report, which they didn't get. We got 17,000 knocked off the number, which was statistically insignificant as far as changing the direction of bond trading. So in any event, stronger than expected NFP took a lot of bid out of the bond market. We're seeing some of those dollars find their way into stocks. The Dow's up 700 points so far this month after a rough start to the year. You look at the last 30 days on the Dow, and it seems as though the Dow is less concerned with the banking contagion continuing to spread. You see a bit of a relief rally that we haven't had more bank failures. That said, you do have some notable individuals like Jamie Dimon, my old boss at Chase Bank, is saying that he does not think we were anywhere near the end of the banking crisis in some comments that he made this week. So just something to keep an eye on. If we see renewed weakness in the banking sector, that could frankly be beneficial for interest rates, because it would signal to the Fed that they may have gone far enough and that any further destabilization in the banking sector could lead to the Fed being more accommodative from a monetary supply standpoint. So in any event, we are seeing bonds selling off sharply today as a result of the non-farm payroll report this morning. Here's the numbers. I think I failed to give those at the start of this, and this is today the Mortgage News Daily tracking for a 30-year fixed conforming loan, 6.34% in that index. On Wednesday, we were at 6.16, so we've moved about a quarter of a point in the last 48 hours owing to that NFP report. Last Friday, we were at 6.57, so we're still about a quarter of a point better than we were this time last week. And we are 5/8 of a point better than we were to start the month. 30 days ago, we were at 7.03%. So we're back into the low sixes, which is good news. Keep in mind that trading is going to be exaggerated today as we had a short day in the markets and light attendance in the markets as well, with many folks out of town. So the sell-off that we're seeing in the bond market reflects very light trading, which is always much more volatile. So in any event, we will see if some correction comes our way next week as everybody gets back to work. Stay blessed, stay safe, have a wonderful weekend with family, and we will talk to you again next week.